All right, welcome back, guys. Okay, so now that we've finished chapter 2, we are moving on to chapter 3, and it's going to be all about transactions. Primarily, this is going to be more about journalizing instead, but I think, I don't know, I just wrote transactions. I thought it'd be fun. So, the very first thing before we can do any journalizing or even consider a transaction is we need to establish what's called a chart of accounts. So we, of course, the chart of accounts, you can update it at any given time, but there are some rules and some key factors about this chart of accounts. The only person that is able to create the chart of accounts is the accountant. Now you can suggest your accountant, oh, I think we should put it in here, but if that person's like, no, I want it in this specific account, you're gonna have to follow through and make sure that that's what the accountant wants. So again, this is just a reflection of what the chart of accounts typically looks like. Again, it is what it is it's a systematic way to organize your information and how they organize all the accounts that you are going to be using. You can either have the option to use an accounting number or some kind of serial number, maybe a letter combination. It just depends for you, all right? And it's in order by type of account. So at the very top, you're gonna have your assets. Then you're gonna have your liabilities in the middle, and then equity, and so on and so forth. Okay. Now this is just a really small chart of accounts. As you can see, the serial number here, it's relevant, right? It's saying the first 10,000 numbers that's going to be used is going to signify that these are assets. Then the 20,000s are going to signify that it's a liability. 3,000s is equity, and so on and so forth. So you can have as many accounts as you want, and if you end up running out of numbers or accounts, of course you could start, creating different account numbers for it, but as long as they fall under the same sequence. Okay. Now this is probably by far to me is it's the easiest way to recognize all the accounts that you have in your chart of accounts. Now you should be given a chart of accounts before journalizing. All right. Before anything happens, you need to have a chart of accounts, right? So again, when we do move on to QuickBooks, this is what it looks like, but you're also given on the side a little balance of how much is in each account. So it's really cool when you're looking at a chart of accounts because you can also recognize, oh, I have this much in my account. You don't need to go any further and look for it or have to tap the account per se. All right. So yes, so it's just a systematic way to keep your chart of accounts organized. All right, so now we're going to be introducing to the general journal. Now there are a few, as you can see, there's arrows everywhere. I'm just going to go through it one at a time. So first things first, well, what is a general journal? A general journal is a book where daily business transactions are recorded. All right, so this is what it typically would look like. Okay, you're going to have five columns. Okay, one is going to be the date. The middle part's typically either the description. This is where your the name of the chart of the account names are going to be, and this is also going to be where you make a little description so you recognize what that transaction was about. You're going to get a post reference number. Now, typically, post reference numbers is going to be the numbers that you find in your chart of accounts. And then you're going to have a debit side and a credit side. So again, remember how we referred debit as left and credit is right? This is why debit is right, and debit is left, and credit is right. Okay, because of the way it's formatted and the way it looks. Now, okay, so general rule of thumb when you are journalizing, okay? First thing you need to recognize that debits go first. Debits will always, 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 always go first. Credits go after, all right? I don't know what the method of or reasoning behind it is, but that is just the rule. You need to record the debits first, and then your credits are going to follow after, all right? And then other things is that you need to also know is when you're journalizing, every transaction that you journalize is going to be in chronological order. All right? Meaning when the day happens, it needs to be all in order. Now, if it's all the transactions are in one day, it doesn't matter what order they are as long as, whatever comes first comes first. But again, if you have a payment that's due 20 days later, that's never going to get recorded until 20 days later. So again, making sure that you understand that when you recognize and you're going to record a transaction, it's going to be in chronological order. Okay? A few other things too I want you to also recognize is understanding that when the rules of recording your debits first and then recording your credits last is, so for example, when we look down here at the bottom, debits will always be left aligned. They will always be left aligned. The way you separate or determine your credit is you're going to indent. You're going to indent. That's going to ensure that that is a credit. So again, when we journalize it, we're going to journalize the debits first. It's going to be left aligned. Then we record our credits second, and it's going to be indented. All right. And then again, when we are looking at the post reference, this is typically, oftentimes you would put your account number in there. So again, my furniture is, the account number for it is 10400. So again, and then these numbers come from your chart of accounts. Lastly, one thing must hold true. Your total debits have to equal your total credits. Okay, so for example, look at the second transaction. We got 500 and then we got 1,000. Those two, if you add them together, it will equal 1,500. So be sure that your debits match your credits. If not, you're going to have an imbalance in your journal. All right. So this is a typical example of the difference between a single entry and a double entry. Okay. So again, it looked just that one entry in for the debit for furniture, it's flowing one way. So that's right here, for example, at the very top, it's flowing $500 on the debit side. If you just only have that one journal, that is called a single entry. But what we require as a accounting system is we require its opposite and equal transaction. So we earned furniture, so that's coming in. We increase furniture. What are we decreasing? We're decreasing our cash value. All right, in the equal amount. So we got $500 worth of furniture because we paid $500 to get that $500 furniture. All right. Any questions about the journal? Okay. It's a lot of information, but these rules must apply. All right. So other things that we'll be looking is called the transaction analysis. So again, this is what the 7 steps I was talking about earlier. So this is the 7 steps of the 7 steps of transaction analysis. So this is when we're given a scenario. This is where we need to understand what the transaction is at hand and what is it asking of us before we record it in our journal. So again, step number 1 is you're going to recognize, recognize the transaction at hand. So what is the transaction, right? What proof of transaction do you have in your hand that validates that this is an actual transaction? So obviously typical things would be like sales receipts or invoices, right? Things that you actually put, it has in terms of money value. Number 2 is going to be understanding how the transaction affects your accounts. So again, if you purposely went out to the store to go buy something for your company, so you need to understand your transaction is you're going to be trading your money, or you're going to be buying with a credit card or whatever it is. You're going to be spending money to receive something else, to get something. So understand what the transaction and how is that going to affect your business, right? You're taking money out of the business so you can buy something that will help the business run better, right? Understanding what the transaction is at hand. Number 3 is determining what accounts you are going to be using. So again, if I'm taking out cash to go buy a computer, right? A computer is considered equipment, right? I'm trading an asset for an asset. So what are my accounts that I'm going to be using, and how does it affect my account? I'm obviously going to be spending cash, so I need to decrease my asset, but I'm increasing my equipment. So therefore, I'm increasing an asset. Then step number 4 is going to be using the business chart of accounts. So again, once we recognize, okay, I'm going to use cash and I'm going to buy a computer. You're going to go to your chart of accounts just to make sure that you have that item in your chart of accounts. If you do not, that is where you can go ahead and ask your accountant, hey, I'm going to buy a computer. There is no computer under the equipment. So can you open up an account so we can properly purchase this asset into our business? And then 5th thing that you're going to do is you're going to use the debit and credit rules. So again, determining, just by determining which account you're going to be used and understanding the flow of it, how do I decrease an asset? I'm going to have to credit. But and then the other one is, how am I going to increase my asset? I'm going to debit. So because I'm going to buy a computer, I'm increasing my asset with a debit. And then when I have to pay cash, so I have to decrease my asset. So therefore, I already determined which one's going to be my debit and which one's going to be my credit. And then you're going to determine what journal you should be using. So again, we looked at one journal only. Your general journal, where all business transactions that you are going to be using. Now, when you go into the actual core of a business, you're going to have a sales journal, you're going to have a cost of goods journal, you're going to have multiple journals, right? But the main focus one that you want to really be able to write down all your transactions is the general journal. Okay? And then lastly, number 7, now that you've figured out everything that you needed to know, go ahead and journalize it into the journal. All right? So any questions about the 7 steps of transaction analysis? All right? Pretty straightforward. Recognize, understand, determine, use the chart of accounts. Then you're going to use the debit credit system. Then you're going to journalize it, and then actually journalize it. All right. Next, we're going to be going into correcting error entries. Now, because you guys are beginners, or I'm going to make the assumption that we're beginners of journalizing our transactions, we will make mistakes. And on top of that, 95% of accounting mistakes are human. So believe it or not, we may write the wrong number, we may hear, and we may see the I don't know, 76, but we actually write it down as 67. It's common that we make human errors. And the one thing and the one rule that the General Journal expects you to follow is, one, you cannot erase, cross out, delete, white out. You can't do any of those when you post a transaction. So, of course, because we're in class, I'm going to allow it because, we're learning how to perfect our journal entries. But this is a rule that applies because when other people look at your books and they see that you scratch something out, they're automatically going to think fraud, because that is typically what people who do normally do fraud do. They actually cross things out, or they forget to put a transaction in, and they try to hide money. So again, this is not because of we're trying to be computers and be perfect. This is because of fraud. So it's good to understand how you be able to correct those entries. So we have two ways of correcting them. We have the reverse and re-entry, and then we have the error cancellation. Now, reverse and re-entry is pretty straightforward. It requires 2 journal entries, and it's obviously going to be the first journal is you're going to reverse the transaction, right? So again, if you're paying for a computer, the reverse transaction is you're going to get your money back, but you have to return the computer. And then you're going to re-enter that transaction again. So I'm going to give you money, I'm going to pay the money back so I can have the computer back. That is exactly what reverse and re-entry does. Now, error cancellation only requires you to have one entry. And what it is basically you're going to have to be very careful because many common people make a lot of mistakes here. They don't calculate it right, or they do it in their head and they think it's right, and they end up getting their correcting entry wrong. This is where you're just going to take the difference and basically finding out which area are you less in, or which area do you have more in, and correct it that way. You're just going to re-enter the same transaction, except it's going to have the different amounts. Okay? So here, for example, we have on September 15th, you purchased office supplies with cash, okay, in the amount of $65. Okay, sales tax is included. You need you recorded this transaction as $56. Okay, correct this error. So again, we went to the store and we paid $65. But because we came back at the end of the day, it's been a long day, we were trying to record our transactions, we end up recording it as 56 because we didn't care to look at the receipt. We just entered it as 56. We catch that 2 days later saying, because my pocket, I brought $75, why do I have less? So then this is how you're going to correct it using the reverse entry. So you're going to pretend in your mind, okay, I'm going to go back to the store and I'm going to return the item. So I'm going to get my money back and I'm going to return the office supplies. And then the next thing I'm going to do is I'm going to repurchase those office supplies and then that means I'm going to have to give the money back. So, but I'm doing it in the correct amount. All right? Any confusions on this? The best way I can explain it is you bought something, you're going to go refund it, and then you're going to go repurchase it. Now the next one so I did the same scenario. Okay, we bought the same supplies for $65, but we recorded it as 56. This time we're going to be doing the error cancellation. Now what we're going to have to recognize is what is the difference between 65 and 56, and we recognize it's just $9. Now let's look at this. Let's look at the scenario and how we can adjust it this way. I bought office supplies for $65, but I recorded it for 56. So therefore, I need to increase my office supplies and I need to pay more cash with $9. So that is the example here. I made the difference. I recognize that I need to increase my office supplies and I need to decrease my cash because I don't actually have those $9 anymore. All right. So now we're going to be moving on to T accounts. T accounts is basically a really quick way to get a sum or to get to recognize the balance in a certain account. For example, I want to know how much cash I have as of now. I spent all this money, I received all this money. Now, how much do I have as of right now? So this is, again, it's just a quick, simple, it's a quick, ooh, whoa, I lost my page. So it's a quick way to just get a sum of money. So for example, here I have a total of 4 transactions. Ooh, sorry. So I have a total of 4 transactions and I used cash for all those 4 transactions. Now I started with $5,124, and here we recognize that we earned money, we spent money, and we spent money. So here I just do a quick simple T account. I know that I recognize that I debited the account by $154, and then I credited my account by 500 and then 65. And what I'm going to do is I want to get a total balance between those two, and I'm going to recognize that at the end of the day, my total balance is $4,713. So again, this is it's not really normally used. I like to use it just because if I'm, I'm trying to think about how much money I have left. This is usually the quickest way to be able to solve it. All right. And then lastly, I'm going to introduce you to the general ledger. So the general ledger, okay, is, hold on. The general ledger is basically the same thing as a journal, except you're going to get one more component. You're going to, at the end of each day, you will be getting a running balance. So when you do the journal, you're just journalizing your transactions, right? If you need to make a quick, to know how much money you have, that's where the T account comes into play. But what the general ledger does is, after you've recorded your transactions, you're going to post it into the ledger. And when you post it into the ledger, at the end of each day, you're going to create a running balance. So you're going to know at the end of every single day that you record a transaction, you're going to know how much you have in each account. So that's the only difference between the journal and the ledger is one is just regular regular daily recording of the transactions. This, the ledger is you're going to get a running balance. Okay? And that wraps up for chapter 3. Wow, that was a pretty short one. So again, what is the chart of accounts? It's basically a systematic way of you organizing your accounts. Here's an example of what the general journal looks like, right? And then understanding the two correcting entries when you do write your journal. You have two ways. You have the reverse and re-entry method, and then you have the error cancellation method, right? Here's a little snapshot of what a T account looks like, and then again, the difference between a journal and the ledger. All right. All right. And that concludes chapter 3 for you.